Hi, everyone. This is Justin Vitter, Events and Programs Coordinator with CBIC. Welcome back for Session 3, Initial Venture Runway and Capital Needs. This component, we have two managing directors of Fahrenheit Advisors who are going to help us with the initial financing round, seed round for startups. So with us today, we have Ben Shealy, the Managing Director of the Charlottesville office for Fahrenheit Advisors, and we also have Chip Bowman, another managing director of business development for Fahrenheit. Welcome, Ben and Chip. Thank you for joining us today.
Thank you very much. It's a real pleasure to be able to present today. And so thank you very much on behalf of myself and my colleague, Chip Bowman. I'd like to thank you, Justin, for moderating, and also thank India Brahm and Tracy Green at CBIC for all their support in putting this, helping us put this presentation together today. The subject matter is convincing and persuasive pitch decks, and the way we plan on approaching that are really in three steps. We first want to talk about the initial process of building up a pitch deck, the various elements that go into that. And then we'd like to also talk about the pitch deck itself, the elements of the pitch deck, what your potential investors expect to see in a pitch deck, the sequencing, and also the emphasis on that information. And then lastly, the pitch deck as a tool, obviously as a tool to raise funds from potential investors, but also a unique opportunity for you as a founder, an early stage company, to think about yourselves, your product, your services, and to put some unique time and attention into thinking about the architecture and how you plan out what you expect to do and the money that will be required, and also very importantly, a timeline, what you expect to accomplish, what you hope to accomplish 6 months, a year, 2 years out. So having said that, our first subject topic is the initial process. And what we plan on describing in more detail is the various elements that go into that process before you actually sit down and begin to build up your pitch book. That can be a very involved process, but I think a unique opportunity for you to spend the time that sometimes it's difficult to make the time to really sit down and fundamentally think about what you're doing. What is your idea? What is your product? What is your service? What problems does it solve? How do you fill those gaps up? What's the enhancement of services? And one of the things we're going to try to address today, time and time again, is the idea of an argument. Making a cogent argument to present to your potential investors why your solution, your product, your service is something that is really going to fit a need, fill a gap, and to compel them to invest in your idea. Chip, what would you like to add to that?
Yeah, I think really as you're thinking about your development of your pitch book, you want to make sure you really nail the executive summary. That's kind of your opening argument, has been said, to talk about your business. Simplify the complex as much as you can to grab people's attention, and talk about the true differentiators for your business. It's your chance to present yourself and help people understand that you're the subject matter expert on your own business. And you also want to make sure that you're talking about and making sure you're identifying, the size of your market and how you're going to grab a piece of it. Obviously, the bigger your market, the smaller a piece you need. But also, the bigger your market, maybe the more elusive it is to get that piece. So you want to make sure that your overall executive summary really makes sense and frames up how you make people interested in reading the rest of your pitch.
And part of that, I think also very importantly, is thinking about who are these potential investors. And as a function of your business, what are your products and services, you probably already have a sense of some of the folks that you're going to go to. who are those people? What other kinds of investments have they made? And it's always helpful if in a preliminary fashion, you can gain some sense of what other investments have they made. Are there similar investments to companies such as yourselves that they've made? And what was it about that appealed to them? I know oftentimes that it can sort of prejudice the process by looking at too many pitch books, but I've always found that very helpful to see how other people have made their arguments. And that sometimes can really inform you as to how to go about it for your process. A key element, I think, oftentimes is identifying those unique elements in your pitch. What is it about your pitch that can set you off from other people that are going to these same investors asking for money? The presumption being at this early stage that it's high net worth, it's very early capital, family-owned businesses, family offices that you'll be going to, and oftentimes there can be a lot of preliminary intelligence that can be gathered as to what kind of investments have they made, what things are of interest to them currently. So that really falls under profiles of your investor prospects.
Ben, let me jump in. One of the other things that I think is really important as you think about unique elements, you want to think about how your product is protectable. If there's intellectual property that is going to give you a leg up and make your business defendable. Also, to the extent you've built a team around it that's got previous entrepreneurial successful experience, especially in a venture type in business or something that's received outside funding, that's really important to articulate. People invest in teams, people invest in defendable products. And then as Ben mentioned, people invest in things that they understand themselves. So, profiling investors that have backgrounds that are similar to what you're doing is really important. If you're getting into a certain segment of the industry or segment of the market, you want to make sure you're at least getting in front of investors that come out of that same segment.
Yes, I think that going back to this idea of initial process, I've seen time and time again, founders, early stage company folks, they will really get swept up in this process of putting together a pitch book. And they will look at a number of pitch books. There's sort of a sequence of various elements of a pitch book. And the feeling is sometimes almost, these are the 7 or 8 things we have to talk about. We must talk about them. It's as though if you don't, you sort of get an F, if you will, showing up for an exam. And I would really urge you to step back and really take some time to think about, if you were an investor, what are the elements that you would find compelling in terms of saying, this is an opportunity, this is a group of people that I really can't miss this opportunity to invest in. And I think sometimes that if you move through the process too quickly, especially initially, you can miss some of those elements. So, and this is jumping ahead a little bit, but I think it is important, if you will, to have a process where there's an initial phase of experimentation where you really are trying to put your idea, your presentation in front of people to test out, is it compelling? What is it about it they like, they don't like? And I think it's that process that will allow you to really hone your approach and produce a product which is a pitch deck which is compelling. The unique elements, I think, are something that at times are hard to identify. And, obviously, many of you have spent an awful lot of time, probably months or years, thinking about your company, totally involved in it. And sometimes it can be difficult to step back and see what are those unique elements. And I think that's certainly one of the things that professional advisors can provide, but it's also something that laymen, if you will, that aren't at all involved or maybe knowledgeable about your business can sometimes point out that can really play into formulating a unique pitch deck that has elements that, will have an appeal, a strong appeal to potential investors.
And I think just a couple of other things I'll add. One of the things, if you're styling your pitch book in PowerPoint for presentations, kind of your elevator pitches or your opportunities in front of investors, I always like to follow something I heard Guy Kawasaki say, which is a 10, 20, 30 pitch deck. So 10 slides, plan for 20 minutes. If they want to hear more, you'll have a window to give them more information and dig in. And don't use a font less than 30. So it's a good way to succinctly and professionally simplify your pitch. If you can't get it out in 20 minutes, people are going to lose interest. So you really need to be tight on that. The other thing, as you think about, prepping and in the process of building your pitch, be cognizant of the fact that if you don't have competitors in your pitch, that's going to be a problem because everybody's got competitors. So, be aware of that. It can be kind of a red flag if you don't think you have competitors. So think long and hard about that. Ask around, ask your advisors, people that are close to you, people who've seen things, because chances are there's a competitor out there. You just might not have seen them yet. But go into it knowing that you need to have the competitive landscape addressed in your process.
Yeah, I'd like to add to that, and I think to sort of underline that point, bringing it back to this notion of an argument. I think many of us have looked at many pitch decks, and they generally will present sort of what we expect to see in terms of the various elements. But at the end of the story, so to speak, you don't feel compelled. You don't feel like there's been a buildup, that, if you will, evidence has been presented, and then it comes together about halfway through as to why this company, these founders, this product or service is really going to, again, it's going to solve a problem, it's going to fill a gap, it's going to enhance a service offering. It doesn't sort of rise up to that level. And again, I mean, when you finally step in front of a group of people, whether it's in person or on the phone, through body language, the feeling in the room, you're going to be able to judge that. But I think that it's very important before you go into the room. And again, I mean, we've mentioned this a number of times, that you have this mindset of making an argument to convince people that they really are going to miss out if they don't turn over some money for you to further develop your idea or your product. And this can be a very elusive thing to do. And if you've never put a pitch deck together before, I think it's something that requires a lot of upfront thought and attention, and then also experimentation to make sure that you're bringing that off. So from this initial process of the time and attention that you'll want to invest before you first sit down and type up some of the slides, I'd like to go on now, unless Justin, you or Chip would like to talk anything more about these elements. If we could go on to the next slide where we talk about the, if you will, the parts of the pitch deck.
You mind if I ask one question to Chip?
Sure.
Real quick, just a quick follow-up. You mentioned that investors invest in teams and protectable products. Mm-hmm. With protectable products, do you find that investors typically demand some sort of patent application or some sort of equivalent at this stage, or are trade secrets generally enough? Second part is, with teams at the seed level, maybe you haven't fully built out your team yet. So what at a minimum would you say you need to be successful? I know it's not a one size fits all kind of thing, but do you have any recommendations on what's a desired team at the seed level?
Sure. So let me maybe I'll tackle the protections first. So that comes in all kinds of different forms. Justin, you mentioned, patent applications, I mean, obviously the farther you are down the path, of developing the protections, the better. But you might be very early in the process. So at a minimum, what you want to be able to demonstrate is knowledge of how you would protect it. So, the pursuit of a patent, but maybe in the interim, you've got, a series of non-disclosures, confidentiality agreements, trade secrets. You've effectively built some walls around it, but, maybe you haven't had the funding to go through the process of the patent yet. But you want to be able to speak to knowledgeably how your product or service or offering would be protectable. The last thing you want to be is kind of bare on that going in. If you're totally silent to it, it's going to leave people to either think that it's not protectable or they have to figure that out themselves. So that's something you need to think through. Does that answer that question, Justin?
Yeah. Yeah.
And then on the teams, so early on in the development of a business, especially at the concept phase or the vision phase, you might not have a large team of people. You might have some advisors, but certainly as you pick your partners, this is a place where the people you align with in your business can help you be bigger than you are. So you want to be careful to, align yourselves with, legal professionals or banking professionals or advisors that can help connect dots for you. The venture community is in large part as much about relationships as it is about the business plans. So people invest in people, and that's what you have to be mindful of. So there's definitely a value proposition that you have to weigh at every decision. Do you go this route with aligning yourselves with somebody that might cost you a little more than you can, just do it on your own. But, they're going to be able to help connect the dots and, and give you kind of some good housekeeping seals of approval along the way. So aligning yourself with organizations in the market like CBIC is an important thing. Being part of that circle and being known in those communities is important. Being unknown, is always a little bit of a impediment and uphill climb. So it's good to be plugged into those networks. And if you are fortunate enough to be a little bit further along, let's say maybe you bootstrapped a little bit before your seed funding, there could be folks that are already part of your management team. Maybe they're sweat equity investors, if you will, alongside you. But they've been there, done that. That always gives people a lot of credibility in going out for seed funding.
Thank you.
Mm-hmm.
So moving on to the pitch deck itself, you can see here we've listed the major elements. And just to tick through those quickly and then come back and discuss them in more detail. I think generally the expectation is initially you'll have an executive summary. We place in parenthetical the word teaser. So I think oftentimes it's very effective to, once you've completed this first draft, initial run through of the pitch deck, you'll produce a sort of a distilled one-page summary. The one-page summary, I think, oftentimes can be sent out to folks that you expect to talk to and some folks that you don't expect to. And from the one-page summary, you can oftentimes gain a lot of good information about how people are thinking about you, your company, and your proposition at a particular point in time. I mean, clearly, today is, by definition, very different from last year and presumably quite different from next year. So, what might be a good idea at one point is perhaps not so well received at a different time. So the one pager, I think, allows you sometimes to pick up some very helpful information that'll allow you to come back and iteratively, further craft your pitch deck. Certainly, there are very few exceptions, but a market analysis of what you propose, making sure that what you're proposing to do, whether it's a service, is addressing a need. I think the worry is, Chip has mentioned many times this to me, the situation where you have a good or service, but it's in response to, well, actually, no one's asking that question. There isn't a need out there. It's a good idea. It's a unique idea, but there at a particular point in time, there just isn't a need for it. People don't want it. Products and services description, that certainly has to be addressed in some level of detail to secure confidence on the behalf of your audience that that you have a command of your field. And then also for a good that is sold, how is that going to be accomplished? What is the media through which it's going to be sold? Who is going to do that? An internal sales force, a distributed sales force, a secondary channel, and so forth. And then, as Chip alluded to earlier, I think that you almost get an F if you don't talk about competitors. I've seen a number of times pitch decks where the argument will be made that, well, we don't have competitors. This is a totally unique product. No one has ever thought of it before. And I can't think of a time where that was true. There always were other folks that were thinking of something allied to your proposition. So I think that a competitive analysis always has to be presented. I always find it very suspect if that's absent. Clearly, a company description. At this point, early stage in a company's life, investors are obviously keenly, if not supremely, interested in management. Who are the founders? Who are the people that you have collected around you to help you? That sometimes can be as important, if not more important, than the proposition, the good or the service. Financial projections. We could speak for hours on this topic. Clearly, if you are proposing, I'll give this example in extremis. If you're proposing the development of a drug, this is there's an arc there of many years, 5, 10 or more years. So your financial projections will speak more to markets, perhaps, that you are interested in penetrating or being involved in than your actual product. On the other end of the spectrum, if your proposition is a packaged good, that's something that's far more tangible, far more near term, and investors would be expecting to see financial projections that have a lot more definition, all the way down to maybe rates of return, a return on an IRR, for instance. I think one thing that's safe to say is that whatever your financial projections are, you want to probably keep that entire financial model, at least initially, a little bit close to the vest. I mean, as opposed to presenting all of the information in an initial pitch deck. I mean, there is this issue of what information goes into a pitch deck and then what is then available for sidebar subsequent conversations. And that's something we can talk about a little more further on. Folks want to see an explicit use of proceeds. What is this money going to be spent for? And then we put the ask, ASK, in capital letters, simply because sometimes in presentations, it's as though the presenter is reluctant or forgets to specifically ask for, in very explicit terms, what amount of money is being sought, and I think that's very important. What would you add to that, Chip?
Yeah, just a couple things. I think as you think about your sales channel and your marketing strategy for the product, it's also going to feed itself into your revenue strategy. So a couple of things to think about, and then I'll jump down to how this filters into your financial projections. So if you're thinking about your revenues, you obviously, I think in the best case scenario, investors are going to want to see contracted recurring revenue streams. You obviously, the better quality your purchasing counterparty is, the better positioned you'll be in your pitch. But you definitely want to think about your revenue strategy. Like I said, ideally contracted, recurring. A little bit less advantageous would be, something that is a repeat, kind of frequent repeat cycle, even if it's an annual repeat cycle sale. What you really want to avoid is a revenue strategy that's all around spot sales. You're selling it hand-to-hand combat. That's going to be a hard funding model for investors to get around because the one-on-one sale is an expensive way to go about it. So think about, as Ben said, your channel market strategy. Again, this is a place where the team can get kind of expanded to, if you have a channel partner arrangement or an outside sales force that you can tie into that's already selling like products or products to the same audience, leveraging that's really important. So think about your revenue cycle as you look at your sales. So as you think about then financial projections, you want to model in how your revenue will work in that financial projection. And I'll just say it because everybody will tell you it, but I see them time and time again. Hockey stick revenue projections, nobody believes them. Because 9 times out of 10, I can't say I've never seen one work, but the hockey stick is gonna have your investor audience running for the hills. So don't ignore people when they tell you no hockey sticks. And then the other thing about your financial projections is you want them to be summarized in your deck, but you want to be able to talk very intimately about how they work. Nothing gives an investor more comfort than knowing that the person they're going to invest in monetarily has their finger on the pulse of the dollars. One of the things to think about is, what's your accounting strategy for how you're going to keep track of the money. As Ben mentioned in this slide, use of proceeds. Part of it is they're curious about what you need the money for. The other part of it is use of proceeds oftentimes will be part of your offering documents where you're specifically saying that you're going to use the money for this, which means you're not going to use it for that. So that's a really important thing to have in your financial projections. Simplifying your financial projections as well, putting them in a illustrative way, more than just black and white numbers on a page, helps people understand how it works, and gives it more intrigue. We do it all the time where you build these multi-tab Excel models, and then you ultimately summarize everything down into about 3 charts. But again, you want to be intimate and knowledgeable about how it works. The other thing I'll say about the ask, money should not be a taboo for you to be talking about when you're out there raising money. If you're not asking at the end for what you need, and already having established in your mind what you're willing to give up for that, it's oftentimes hard for people to understand how to engage with you on it. So you want to be clear, how much of the company are you willing to make available for people to buy into? What's the valuation? How did you come up with that? And how much are you asking them to consider investing alongside you? And there was one other thing I wanted to say. The other thing is you want to think about your ask in terms of the milestones you're working to get to. So you really need to understand how much money you need to raise in order to get to the next milestone in your development of a company. Nobody wants to build a bridge to nowhere. So your investors are going to want to invest in you during this period of time that you're working on moving your company from here to there. And then understanding that the process of moving from here to there, if you're successful, is going to increase the value of the business. At which time you would, rinse and repeat and analyze how much money you need to raise to get to the next milestone. So think of the fundraising in terms of your different rounds. Rarely are there situations where you can get from zero to the finish line with just one round of funding.
Picking up on one of Chip's comments about hockey sticks, I've seen a lot of hockey sticks, and they've never come true. Having said that, I think the real art to this is that you want to obviously be truthful, honest, but in your proposition, I think that there's this fine line between presenting financials that will be attractive to an investor and still credible. And I think going back to the comment about the hockey stick projections is I've seen presentations that have gone extremely well. They're exciting, they're compelling, they make the argument, and then you get to the page with the projections and it's a hockey stick, and it's as though you can hear the air come out of the balloon in the room. The credibility gets blown, and I think it's very hard to build that back. So I think that's extremely important to, if you will, to have a sense of calibrating that presentation from beginning until end, and be mindful that great presentations can really be wrecked by unrealistic financial projections that lack credibility. In total, going back over these elements and thinking about them, and again, there's no prescription, there's no answer overall. It's unique from presentation to presentation, but I think it's very important that you think about the sequencing of how you present your information. It varies from business to business, and also the emphasis that you place on the various elements. I mean, clearly, if your product is a highly engineered product, then you're going to have to spend some time emphasizing the excellence, the knowledge, and so forth, the innovation of the engineering aspect, the idea, the people involved, and so forth. If engineering, if the technical end of it is not significant and it's more sales and marketing, well, again, by definition, the focus must be on that element. And in saying that, I think that it is important, if possible, that the presentation is not solely delivered by the CEO. I've been to many presentations where one person will speak for 45 minutes and the other, quote, supposed team members sort of sit glumly on one side of the room, and we never hear from them. And I think that the suspicion oftentimes that investors have is that, well, this really isn't a team. It's an entrepreneur, it's one person, and that sometimes one person, it's notorious that they can't really manage teams. So I think that it's important, if possible, to take these various elements and break them up amongst your team so you can have one person speak to their expertise. I'm not saying that the CEO shouldn't be, if you will, for lack of a better term, the controlling influence, begin the presentation, chime in whenever it's appropriate, and end it. But nonetheless, I think it sometimes can be a real mortal mistake to just have one person run through all the information.
Can I ask one question to the both of you? If you're a startup that is part a service provider and part a products provider, what should you pitch one more than the other, and if so, why?
So I'll take the first stab at that. So a lot of times, products are developed out of service plays. So I see that a lot, especially in technology or software environments where a service is being provided, you become aware of the client's need, and you develop a product to solve it, and then you realize, wait, that's a product I can sell, maybe even protect from an intellectual property standpoint. So I really think it matters more than anything, though, is which one has the revenue trajectory that's going to be most fundable. And oftentimes they're going to work together. The thing about a product, if it's a product that is by its nature contractable and recurring in the stream of revenue it can produce, that's going to be something that will have more appeal, I think, to investors than a service where you're required to show up, time and time again, or continue to provide something ongoing. The other thing from a financial projection and modeling standpoint is a lot of times service businesses are paid in arrears for services provided, unless there's some ability to do subscription. A lot of times products are available, you pay up front. So even if you've got a subscription and a life cycle to that product where you might have to defer the revenue, from a cash flow standpoint, you get the money up front. So each situation is going to be unique, Justin, in my opinion. Ben, what do you think?
Well, what I would add to that, and I think Chip, as always, is spot on, that it's a question of the model itself, the revenue streams. And I think that if there's a predominance on one side or the other, that the predominant side would sort of lead in terms of the presentation. One thing I would add, and again, this is very tricky, but for businesses where the proposition they're making, the argument, if you will, is somewhat in a state of flux, that sometimes can be helped along or defined by potential investors. And what I mean by that is, if you have a company and you know that there are 2 or 3 people who have a track record in funding that type of company, those investors sometimes can telegraph in some subtle and not so subtle ways, what their interests are. And that can really play into how you structure your pitch deck and the pitch itself. And that sort of goes all the way back to the head of the discussion of, doing homework to find out, who are the people that you're going to go and talk to, and, what are their interests. So if Chip, Justin, if you don't have any other comments or questions, we can go on to the last slide, the last subject topic. The tying it together now, we'd like to talk a little bit about the pitch deck as a tool. Now clearly, it is a tool to present to potential investors, to inform them about your company and your desire for money and what you plan on doing with that money, and what potentially their investment can mean in terms of buying a piece of your company. And I think sometimes that, this might seem very odd to say, and you'll scratch your head when you hear it, but I think one can lose sight of the fact that it is a marketing tool to investor prospects. I've found founders, early company folks, sometimes will spend enormous amounts of time polishing up a pitch deck. And I think they lose sight of the fact that, hey, this is your tool to put in front of investors to secure money from them. And I think it's important as you go through the process to come back to that. Also, one thing I think you will find is that you put your pitch deck together, you put a teaser together, you get some initial feedback. There is this process, an iterative process of fine tuning. Certainly, in extremis, perhaps you go out and the offering is for equity, and what you get back from investors is, we have no interest in equity, we want convertible debt. So I present that as an example of one aspect of feedback that you'll get from investors, but it can really run across the board in terms of your operating, your marketing, all the other elements of your pitch deck. Serious investors can really provide guidance and information. And sometimes, just very blatantly, we will only invest if we can see ... And then it's up to you as to whether you want to accommodate that or just move on and see if you can, put the deal together as you initially conceived of it. Again, it's the fitness and strength of your argument, I think, that really is the defining sort of the backbone of your pitch deck, and constantly having that in mind. Levels of disclosure, this links back to something I mentioned earlier about how with a financial model, oftentimes, certainly you're going to build a financial model. Question is that going to be completely highlighted in your pitch deck? And I would argue that most of the time it will not be, that it will be adumbrated. There'll be a summary, a representation of it, but that you will sort of very carefully, almost in layers, think about what data you're going to present, and then what data you would have in sidebar or follow-on conversations. And of course, that plays into not only the financial aspect of the pitch deck, but also strategy and tactics. A deal structuring, as I mentioned before, that's something that oftentimes will come up, that you'll go out with, if you will, one flavor of deal, but what you'll hear from investors is whether it's a different form of money, options, and so forth, they'll come back with a counter proposal, and then you need to go through the steps, and usually with an attorney, an accountant, a consultant to think your way through the advisability of doing that. I think an extremely important aspect of this that's oftentimes overlooked are life cycle concerns. The most blatant example I would give is that certainly as you begin your process, you will be going to early stage investors, high net worth, family office type investors. It's unlikely as a first time investor you would be going to a professional money, if you will. Professional, by that I mean venture capital, venture debt, and so forth. But by lifestyle concerns, what we're trying to highlight is that if in a new business, if you're going to high net worth folks for money, that makes perfect sense. But if 10 or 15 years into your venture, you're still, if you will, living off of high net worth money, you've probably really gone astray, because there is if you will, a life cycle to investing, that you progress from one type of investor to the next. And I think that your business plan, your pitch deck as a tool, allows you to sort of map that out. What are the expectations? And this links back to a comment that Chip has made several times about preparing yourself in terms of milestones and expectations. Because as Chip said, no one wants to turn money over to you to build a bridge to nowhere. They want to know what the plan is and what these stages are. And you will sometimes hear, in my opinion, I think oftentimes a very naive thought that we will somehow be able to, through early stage money, do an end run around professional money or venture capital and get all the way to a strategic sale or to an IPO. And there are, I suppose, examples of that, but it is truly the extreme. And of course, that I think is in essence, the point we have about mapping the future, mapping your trajectory, how you expect to sort of progress to that next point, and then the point thereafter.
One thing I'll add about the pitch process, as you start to deploy the deck that you've built, which is the product of the good thinking about all the things that you need to disclose and talk about and how you excite people, is the use of this deck is about sharing your excitement for this product. If you're not excited about it, chances are the investors you're talking to are not going to get excited about it. It's not impossible that they'll see the diamond in the rough on their own, but people want to know that you're passionate about what you're building. The other thing I'll mention is, it's also helpful to make sure you clearly define your process as you run through, the presentation, as you're thinking about timing of the raise, when you want to raise the money, how you want to use the money to kick off the next phase of your business. Be sure that you put some time parameters around people. Otherwise, you could end up in a situation where there's kind of due diligence purgatory or analysis paralysis occurring, and you never actually get to the closing. And then the last thing I'll say, I think Ben appropriately called it a tool. It's also the chance for you not only to present your vision and your excitement and your business to investors, but it's your chance to get an interview of them as well. The investing is not just about the money. It can end up just about the money, but it's about aligning yourself with folks that can help, that can be supportive, that have a like-mindedness. So using the pitch deck to tease out questions from the investor pool is a good thing, as you in as much interview them as they're interviewing you. I mean, obviously they've got the money, so you're more in the hot seat than they are. But don't miss using it as a chance to hear from them as well.
To that point that Chip just made, which I think is a really great one. I think that not only do you want to get to know those investors better, one of the reasons you want to get to know them better is because it is extremely likely that if they turn over money, you're going to need to go back to them for a subsequent round. And I think that the earlier you establish an extremely, the best relationship you can, and I think one of the ways you can do that is by a real fruitful dialogue. As Chip said, questions to them, trying to get to know them better. And I think that in so doing, you're going to be able to better anticipate, their needs, their questions. And when this works the best, when I've seen this work the best, investors aren't just turning over money. Some of them have some real operating experience, and very importantly, oftentimes they have friends and relations that also can write a check, and that is, that's something I think obviously one also needs to be keenly attuned to.
Cool. Well, thank you, gentlemen. We are about out of time. If it's okay, I'd like to ask one question left on my end and then leave it. If you have any other comments you'd like to make, please do. My question is, when you're a founder and you have multiple prospective investors kind of all over the place, and you're trying to manage how to execute and bring it all home, close on all the deals, but some of these investors want different terms, these investors want equity, and these investors want convertible debt. Some are individual angels, some are angel groups, some are family offices. Do you have any advice on how to have a objective process to try to get to the finish line without getting lost in the weeds?
Yeah. So one thing, this is a secret I learned in deal work a long time ago, is if you don't start with the end in mind, you'll never get to the end. So what you need to do, and one of the other things in deal work is, oftentimes the first one to the finish line wins. So, I think there's a lot of juggling that has to happen in deal work, especially if you've got multiple potential investors. Sometimes those investments are mutually exclusive. You've got to go one way or the other. Other times you can find ways to bridge together different objectives and different deal structures to build a stronger team. Maybe accommodate investors that like two different types of instruments, but effectively work to get the terms of those commensurate with each other. But yeah, there's a lot of juggling. I always find it's helpful when you're evaluating alternative deals to write down the pros and the cons of the different deals. That way, it sometimes helps bring into clarity which direction you should pursue. And you know, a great backup plan usually makes your A plan that much better. So.
The only thing I would add to that, and this may sound a little simplistic or heavy-handed, but having been in that situation a number of times, and to your question, Justin, I mean, truly, if you had if you will, sort of a heterogeneous group of investors, people signaling that, yes, we're interested, but we're sort of interested in different instruments, we're interested in different, different approaches, if you will. What we have done is we'll sort of identify that person who's offering the most money, and then identify the person that's the most appealing. And generally, it's not the same people, just in terms of, and when I say most appealing, you know, that investor where you think, well, not only is this person going to write a check, but another check, they've maybe got some operating experience, maybe a potential board member down the road. They've got friends, you know, like-minded and so forth. And you sort of line those two up and see, you know, is there a deal? Is there an instrument that would attract both of them? And sometimes that's just not possible, but that would be the process. The question, is there an approach, an instrument that would appeal to both of them? You know, try to punch through to that, and then contact all the others and really, you know, make the plea that, you know, we've started to have, you know, sort of a nascent deal bubble up. And, you know, this is the only way it's going to get put together. You know, can you join us? I mean, again, it's you know, as Chip said, there's a real art to it in terms of trying to collect people together, and it's just and acknowledge the fact that oftentimes you are simply not going to be able to sort of thread that needle and attract everyone. I do think, though, that, as Chip said, you know, starting off with an end in mind, if you have a reasonable structure suggested and outlined from the very beginning, I do think it is easier to cleave to that, to try to pull people back to that time and time again. If you go to them with something that is very open-ended, I think, you know, no pun intended, you really open yourself up for this kind of confusion in the end game.
Yeah, the other thing I'll just add quickly as a follow-on that Ben reminded me of is, you know, make sure that you go into that process understanding your absolutes as a business. You know, so the last thing you want to do is shift midstream in your fundraising process to a situation that doesn't actually give you the tools you need for success. So you might align emotionally or strategically with an investor, but if they don't provide you with the capital necessary to get to that next milestone, you know, that might be the absolute that you can't waver on, because, you know, no matter how much you like them, if the resources are not sufficient to achieve that plan, you're going to end up having to settle or risk failure on your plan.
Well, gentlemen, thank you both for taking the time today. This was very insightful for me in particular. Thank you. That concludes part 1 of session 3. Please join us on Tuesday, June 9th. We're going to have a live webinar where Fahrenheit, among some of our other sponsors, will be taking questions live as well as previously asked questions. That being said, thank you, and look out for part 2 of session 3, which is going to focus more on something we've discussed a little bit here, which is the actual instruments that will be used in the initial financing. And really what this comes down to many more times than not is, are we doing an equity round, or are we doing some sort of non-priced convertible note safe equivalent? So, and that will be spearheaded by Keiter and McGuireWoods. Thank you again. And also, lastly, just a last quick thank you to our sponsors, Wells Fargo, Keiter, and McGuireWoods, as well as our supporting sponsors, Fahrenheit Advisors, Catalyst, CSH Development, and Leidos. Thank you all. Talk to you soon. Thank you. Hi, everyone. Welcome back. Justin Ritter here, Program and Events Coordinator for CBIC For the Founders Series, Session 3, Part 2. Now we're going to learn about paving the venture runway. We're going to be looking at the initial division of the equity pie, if you will, of a given startup. Today we have, again, Steve Keeler with McGuireWoods here with us today. Hey, Steve, thanks for taking the time. We also have Matt Austin, who is a Managing Director at Keiter Advisors, a mergers and acquisitions specialist. And thank you, Matt, for joining us today. Appreciate your time.
Great to be here. Thank you for having us.
Today, we're going to be discussing this initial division. Just want to have a nice informal discussion about why it's important to get it right at the beginning, because there are many things that could potentially go wrong down the road once you get to your exit. And so with that, we have a nice PowerPoint provided by Steve. Steve, I'll let you go ahead.
Great. Thanks, Justin and Matt. It's great to see you again. And we worked together years ago. It's great to our paths have crossed again. So in prior sessions, we've talked about product and solution, getting your idea off on the right footing, and then thinking about the ink. If you look at this first slide, sort of converting your business idea and revenue model and so forth into a legal entity. And we covered a lot of the boring but important legal and tax issues around forming the entity. Today we're going to talk about what Justin and Matt and I often refer to as dividing the pie, the capital structure of a company, the ownership structure of a company. And you hear a lot of talk amongst founders and investors about dilution, how much do I own, and how do I minimize dilution if I'm a founder. And certainly we're going to speak from the founder's perspective today, although Matt and I have represented investors, private equity funds, and buyers in the past. So if you kind of run through this slide, we were talking about this before today's presentation, is getting ready for this. It's interesting. We really encourage clients and you as entrepreneurs, founders, to be flexible, because you really don't have an accurate crystal ball. We always make a joke that don't believe your client if he or she says they're going to go public in 3 years or 6 months, or they're going to sell, or they're never going to sell, right? If it's a family business. And because you can't really make those promises. And we're in a dynamic innovation economy now, and we really plan by quarters as opposed to years, 3 to 5 year periods, even for family businesses, new environment. So as you make decisions about forming your company and then dividing the pie, if you will, you do want to have that future exit, that the big party where you hopefully liquidate the equity value you've built. And Matt's going to speak more to the importance of these early steps and how they can impact the future. But we all really work to sort of calm your fears as an entrepreneur, that you're not going, no decision is going to be perfect. No decision is going to be made in a vacuum. You're going to choose C Corp or LLC. You're going to issue options to key people. You're going to enter into an agreement to divide the company up among several founders. So you do your best, but today's topic really is more about, or the approach is, you don't want to just kick the can or roll the dice without any discussion and planning around these steps and the steps of dividing the pie. The pie is the company's ownership. It's equity, it's stock, it's LLC interest. And the first group of folks that kind of look at their slices of that pie are the founders. Many of our clients just have one founder. Some of our clients have one controlling founder with two very key co-founders. We do have a lot, and I think you all see this on the internet, LinkedIn, et cetera. A lot of companies do have 2 or 3 supposedly equal founders, which is always an interesting concept. You know, wow, what a coincidence. How perfect is that? 3 of us have started this company and we're all equally valuable. How often does that happen? So this first group are the founders, and we'll talk about that. The second group, of course, are the key people who might be developers and other key people in the organization, CFO, CTO, CIO, that are looking for some equity strip as part of their compensation package because you're going to underpay them, right, relative to Facebook or Amazon or another potential employer till you get the company off the ground. So founders we talked about. Helpers is this class of key people who might be part of a multi-tiered stock option plan. Some of them might be independent contractors. Some of them might be employees. Separate tax issue for another day. And then lastly, today we're going to talk about angel investors, or your first equity investors who are not service providers. And these range from friendly university investors to family and friends, rich uncles and aunts, to what we see a lot of in Virginia, Charlottesville, Richmond, Tidewater, as folks see in Austin and Denver and Silicon Valley, deep-pocketed angels and family offices that love your idea. They like your vertical. They like your space. And they're willing to take a riskier pre-Series A, the institutional round that everyone talks about. Before you get to a Series A, which Justin will talk about more in even future sessions, you need to bridge finance, right? So, you're going to charge your credit cards to the max. You should approach non-dilutive sources of equity like government grants, royalty, participation plans. So try to exhaust all of your non-dilutive sources of capital, including your own pocket first, but then you're probably going to need some angel financing to bridge the company from the early stage to a stage that where you've got revenues, hopefully some profit, and you'll be ready for a Series A. So let's talk about founders. I'm going to hit just some quick bullet points, and before I go to the next slide, I'll invite Matt and Justin to talk about this. I really think the mistake that I make and that founders make, we're all guilty, is to assume that the founding of a company is a love fest. It's always going to be that way. We're always going to be great buddies. We probably will be, but without documenting the arrangement between multiple founders, things can quickly go awry, even if you're all good people, or we're all good people. And what I mean by that is, I think too few groups of founders have an honest discussion about what they're each bringing to the table, what they're going to bring to the table, who has already quit their day job and is working full-time for the company, who's moonlighting until they can afford to leave their current job. So the two issues for founders really are, how do we divide up 100% initially, right? Are we equal partners, or are we really 40, 20, 20, 20, number one? And two, and this is where sort of the prenuptial agreement concept, like a lot of husbands and wives enter into, comes into play. If one of us leaves, what should happen? Well, hopefully what will happen is that we'll hug, we'll shake hands, because that was in the old pre-pandemic world. But we'll part company friends, but the legal document will be clear that I won't leave with all of my equity if I choose to move to the beach and quit in 3 months and I don't fulfill my 24-month commitment to this venture, or I get sick, or I have bad personal times. In any of those events, founders should have had a discussion about what happens if one of us cannot stay the course. The other thing on this first slide that you hear at cocktail parties, I sort of want to nip in the bud, is when we're dividing up the stock amongst founders, you hear a lot of talk from the West Coast about founder stock. It's sort of super powered, sexy, special voting stock, so that even if the founder only owns 40%, she might have 70% of the vote. Or even more fancy, if you will, founder stock is also automatically convertible into preferred equity when we do preferred rounds. I really believe most advisors agree that if you inject that kind of founder favorable stuff into your founder stock terms and your cap table, it's certainly not going to help your fundraising efforts. It might even hurt those fundraising efforts. Frankly, the Series A may come in and say, you got to scrap this anyway. So the purpose of sort of this idea to Inc. Now What is about have a discussion over coffee, beers, or your favorite signature cocktail, because it's important about who we are as a team if there's more than one founder, and what are our expectations about sharing the pie with the option pool type of folks, the tier that comes after the 1, 2, obviously 2, 3, or 4 founders. So that's all I've got on that first slide.
And Steve, what I would add to that, I couldn't agree more with the prenuptial agreement. So many times we see situations where people didn't bear down and kind of write the rules of the road when times were good. And by the time things got bad, it was so hard to go back in time and recreate it. It usually, frankly, unfortunately, ends up in some form of litigation.
Yeah.
And if you're in the middle of a trying to raise capital with that kind of uncertainty, nothing can be more disruptive than having your own team that's supposed to be unified while raising capital, that to be up in the air. So having it buttoned up early, I think, is right on. And then in terms of thinking about fundraising and the founder stock, ultimately, I think a lot of investors, professional investors, and even friends and family types of folks that we're talking about right now, they are looking to the team as a steward. And so to the extent that you're going to have unusual rights relative to them, and there may be in certain rare circumstances, appropriate times that those come into play, but the idea of partnership is going to come in pretty importantly, because if you in your evolution of your company continue to go down the path, you're not going to be the only person kind of making decisions eventually. You're going to have a professional board. And so
Right.
thinking about those things now and getting accustomed to, being a steward of someone else's capital, just like it was your own, I think is so key from a founder's perspective to getting that mentality. It's going to help you a lot when you deal with whether it's angels or, other types of institutional investors. It's great to be in that role. And the last thing I'd add is on the pool of equity, when you create a pool of equity, you don't necessarily have to assign it all right away. A lot of times when you get farther down the road, there can be a pool reserve, but uncommitted. So, those are the only things I was going to add there, Steve.
Great points. Great. Anything from you, Justin, before I go to founder stock? Anything from you, Justin?
I think
Comments or thoughts?
the only thing I would add is as a founder, be very careful on who you actually add as a founder versus someone who you can still get on board with a nice stock option or profits interest equivalent, because the consequences of the former owner breakup versus the latter are much more adverse. And so it's just something,
Absolutely.
being
Yeah.
2020, to think about very, very hard.
Yep. So the last bullet under founder stock, well, two things. Double trigger is cool, and we can show off with some of the lingo, but a double trigger is a vesting provision where most people know that vesting means you get the full value of your equity if you stay long enough or you satisfy certain performance standards. So most of the people on this webinar or who are watching us know that it's pretty common, for example, to have 3-year vesting or 4-year vesting. So you get none of your stock if you leave 6 months. You get 25% at the end of a year, and then maybe you get monthly, quarterly, or annual vesting if you, depending on when you leave, from 3 to 4 years. Double trigger is kind of interesting in that it says that on top of what we're going to ask you to live with, that is, you've got to stay for 3 years to keep all of your equity, we want you to stay for an extra year or two if a buyer of the company matches your salary and asks you to stay on during a transition period. If they give you as good a deal as you have with the company now, we want to incentivize you to stick around just during that 12-month transition and integration period. And I see that quite a bit out of DC and the Silicon Valley, where investors, whether seed investors or Series A investors, are smart enough that they say, if we go to sell the company, we want you, Mr. CEO or Mrs. CFO, to stick around for a 12-month period. And if you don't, and that assumes that the buyer keeps you and that the buyer covers your current salary, you don't get a pay cut. We want you to stay around for an extra 12 months to help the buyer get its feet in the boots of the business, if you will, before you leave voluntarily, and we'll hold back 20% of your stock to do that. So double trigger just means single trigger is you've got to stay with our company for a period of time to earn all of your stock. A double trigger would be if before you are fully vested, we hire Matt Austin to sell the company, or we get a preemptive offer from a big strategic player that we just cannot turn down. We want to provide that double trigger or incentive. You may not like it because you don't want to be working for somebody else, but we're just asking you to stick around for 6 months to 12 months, and we're going to hold a little of your stock back to do that. How does that work logistically? Essentially, all the money that would have been paid to you for your stock, a lot of it would be paid to you at this closing, but some of it would be escrowed pending as long as you stick around. If you're terminated without cause, you don't have anything to worry about. So that's enough on double trigger. The other thing I just wanted to add, the final bullet is, and I think Matt sort of touched on this, if you don't have a plan, that is, I ask clients all the time, I understand you all set up your corporation. Do you have a shareholders agreement or an operating agreement that talks about what happens if Justin or Matt become disabled, they die, they take a powder and just want to go surf and live at the beach, or just they lose their drive, inside of 2 years? Not our deal. Do you have anything in writing that talks about that? And the answer is quite often no. Trust each other impeccably, and but what that raises the risk that we've talked about. you've got that morale problem. I remember a client that had a Series A financing. Their former CEO was still on the cap table, no litigation. Former CEO was still on the cap table, living at the beach. Was sort of pushed out. It was actually his own, it was mostly his fault in my view. He had 22% of this company all the way through an exit. Now, imagine what that does to the morale of the team. And what would have worked is pretty founder-friendly terms, whereby if you leave before we hit a triple or sell the company, or before a 2-3 year building commitment is up, or you obviously, if you steal or you're not a good player, or you become disabled, maybe you're treated more fairly. None of that was addressed. And it was hard to bring in new people with the drag of that 20% ownership that he ultimately, if you look back at it, didn't really deserve. If we don't have something in writing, a Series A investor, typically a venture capital fund, will come in and say, we got a plan. And our plan is 5-year vesting, and we don't want that, right? We want 3-year vesting if we're founders, or 4 years. But if you're not careful, the Series A will ask for 5-year vesting to keep you around while you spend their money, as well as perhaps more onerous terms that would apply if you die or becomes disabled, or other events that are clearly not your fault occur. So, better to say to the venture capital fund, love the term sheet, we're really excited about bringing in Bain Capital, but we've already got a plan. And in my experience, most funds will say, okay, we're good with your 3-year vesting plan. We're not going to cram a 5-year vesting plan down your throats. And you guys were smart enough to do your prenuptial agreement, and we're not going to mess with it. So if you don't have a plan, the Series A will come in. They often even want to rejigger the ownership. We see Series A funds come in and say, believe it or not, your CTO has too much equity, or your CEO has too little equity. I mean, it surprises people to hear that, but the investors often have strong ideas about how the equity would be shared among me, Justin, and Matt if we were the 3 founders. And you would think that it's none of their business, but to Matt's point, it is their business, because we're fiduciaries and they want the allocation of equity to be aligned with our contributions. They want the appropriate incentives. If they think the CEO has too little stock, that keeps them up at night because they don't want to lose the CEO. So I'm ready to go to the helpers slide, unless you gentlemen have anything to add on sort of the horse that I've beaten. Get your founder agreement expectations, even if it's simple, in writing. But now we can talk a little bit about the next tier of non-founder folks, the helpers, unless you guys have something else.
Yeah, I would think the only thing, Steven, it's back to something that Justin mentioned, is I think a lot of times founders sometimes make the mistake of there's a perception that equity is easier to give than cash because they don't see the immediate cost of it. And it's just one thing to keep in mind. At the end of the day, that equity is very expensive. So, just be very judicious and thoughtful, and seek the opinion of your trusted advisors when you're going through that exercise, because it's easy to become, passionate. Hey, you got a good friend, or you're, someone that's working for you. You think they deserve some extra equity. It's just very difficult to unwind those discussions once you've made that. So be very thoughtful and intentional when you go down that process.
Great point. So it's interesting, Justin and I talk a lot about cocktail party talk about options, what's market, is your preferred stock participating, does it pay a dividend, blah, 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 blah. In the world of employee equity, helpers can be independent contractors, 1099 work from home developers, or they can be employees. And it's interesting, Matt's point, careful about what you promise on a dinner napkin after several beers, because a lot of times we have clients come in and say, somehow she got it in her head I was going to give her 5% of the company. And oh, by the way, the 5% is not dilutable. So if we bring on money, she wants her 5% to be non-dilutable while I'm being diluted. And so it's not that you need a lawyer to screw in every light bulb, but we do run into a lot of well-meaning founders who've made promises to 2 or 3 people and they just never pay for it. And it's embarrassing if you engage Matt to raise institutional capital or sell your company and we're racing around to get stock option agreements signed. You granted the options 3 years ago and there's no paper. It doesn't make, the company doesn't look good. And it causes a buyer to look under the hood and say, well, if they didn't even get around the stock option agreements, what other places might we find dead bodies at this company? Do they have their trademark registered? Did they get non-disclosure agreements from their key people? So as in all areas that Justin, CBIC are covering in these sessions, the good legal accounting and corporate finance planning ultimately adds value to your company today, because if a buyer and investor looks at what you've done along the way and you've built the house with a good foundation and you've done things by the book, they're going to view you as an A+, we call them clients. They're going to view you as an A+ entrepreneur. Don't blow money on lawyers and accountants, but don't be Penny Annie and avoid important steps. So on the helpers front, we look at this sea of people, some of whom are independent contractors, some of whom are employees. Most of the time, we're dead wrong about which is which. We sell a lot of companies where the buyers determine that a lot of our independent contractors are actually employees. That's kind of a tax issue. Uber got in trouble over that years ago in the sharing economy. They were held responsible for a lot of their independent contractors. So a lot of people call us and say, what's a fair percentage of the company for a CEO? Well, the person who answers that question, other than I don't know, it depends, is a liar. Because I've got clients who hold 30%, I have CEOs who hold 60%. It depends. It's a little easier to answer the question to Matt's great point. If you're bringing on people and they're not founders, they might be a little late to the game. A CFO, developer that is key. But if they're not a founder, it's a little easier to talk about the percentages we see for other C-suite people. 2%, 3%, 5% starts to get a little rich in my book. And then when you go down to that group for a bigger company, of course, the group of 5 people to 25 people, right, at some of our local companies here in Charlottesville, like S&P. One time SNL had 100 LLC profits interest holders. That many employees with equity. Hard to believe. Silverchair, one of my clients, I'm not going to talk about him. Don't say anything that's not public. World Strides. These companies surprisingly have tens of 20s of, they can wake up and they've got 30, 40 people holding options. So there are different tiers. Different companies have different tiers. Founders, and then beneath that would be the C-suite, the guy or woman we've got to have from the West Coast, right? They're going to negotiate for more equity and comp. And then when you get down to what I call sort of I do it respectfully, the rank and file, where people are going to hold less than 1% or a percentage of the company, you really start to talk about pools or stock option pools, right? Reserves. And for whatever reason, it's sort of like 80%, 20% in private equity funds. Carried interest is 20%, the investors get 80%. The sort of unwritten, unstated rule for option plans is throw the paint against the wall, but 20%, 15% sort of looks right. And the funny thing about the world is the three of us and all the great entrepreneurs that are listening to this and other professionals are just as smart as the Series A. The Series A come in and they are the masters of the universe. And they tell you that your advisors are crazy to suggest a 30% pull. Fact of the matter is there are no hard and fast rules, but in the Series A have their own ideas. But we do see 10, 15, 20% reserves. Matt suggested you don't have to issue all the equity, right? So you might have 3 founders owning 1/3 of the company with a 10%, 15%, or 20% reserved pool for future grants to employees. Sometimes we do a lot of those at once. Sometimes you're just granting options as you hire people till you get up to that necessary team of 10 people, 15 people, or more. And in a lot of these tech companies, the culture is such that you're really doling out a little equity to everybody, a much broader cross-section of people than most of Matt's private equity-backed companies that don't spread the equity quite as deep. So when we talk about a stock option plan, it's sort of the same thing as a pool for service providers or sweat equity holders. People are not going to put any money into the company. So you talk about this stock option plan, which you can have in a corp or an LLC. We won't talk more about profits interest today. I'm a big fan of those. They're kind of misunderstood and they're screwed up on occasion, but they're unique to LLCs. You can give stock to employees and founders with little to no tax consequence if it's not worth anything, right? We often offend our founders by saying great business plan, great model, but if you grant the equity to the group of founders today, we can probably be pretty aggressive that this company's not worth a heck of a lot until you finish your revenue model, raise some capital, get your CTO on board, perfect the technology. So the earlier that you can grant actual stock or grant options to purchase stock, the better for tax purposes, because your company's not worth as much today as it hopefully will be in 2 to 3 years. I'm not going to get into as much tax depth now. Just understand that crossing the Section 83Ts and even Section 459, where it's important when you grant options to have an exercise price that's, you can put your tongue in your cheek and say that feels like fair market value. Keiter will do valuations for companies to be really safe on that. Darden, Bell, and I talked a little bit about some of these issues a few weeks ago. Believe it or not, there's actually a securities law requirement for granting options and issuing stock to employees. And that's what 701 is all about. So these are in the slide such that you can ask your counsel about them. Justin's going to bring them up. Keiter's going to bring them up without being asked. I'll bring them up. But if you don't hear these numbers from your counsel or current accountants, it's worth bringing them up and checking to make sure you're crossing those T's. So we talked about this a couple weeks ago. Last bullet, practical, real world. cap tables, get one, right? Get a software program where you can keep track of who owns what. It's just amazing how few companies keep their option lists up to date. Do you have a stock option plan? Do you have paperwork? Hopefully it's electronically stored, but cap tables can become a complete nightmare if you don't keep track of them from the day that the 2 or 3 founders form the company through the date that you grant options to 5 or 10 people, through the date that you bring on 10 investors who are angels to do a seed round. So that's really what I had to talk about. We've talked about founders, the prenuptial agreement. That's a sort of a song and dance about the helpers, pools, stock versus option grants, open to questions from you guys. Our participants will be able to ask questions after this webinar and a future event. But before I get in to angels, the third class after founders and helpers, and the cool terms mess and seed, I throw it back over to you guys to let me breathe for a few minutes.
Yeah,
something to add.
Yeah, Steve, I
Yeah.
think one big thing that you raised with regards to documenting your investor rights and tracking options, or whether you have options, profit interest, or some other kind of incentive equity, or just the equity in general, is again, when it comes time to do that next round, Steve mentioned, hey, not only is it does it shed a poor light if you don't have your ducks in a row. The other thing is nothing gets folks more on edge if something is not right with equity. If someone feels like they're getting shortchanged on equity and it wasn't related to the deal that they understood, it can really create a problem in getting a round closed, or in the event it's an M&A sale, getting something closed, because there are certainly representations and warranties that the founders and owners will make around that. So you will save yourself a whole lot of headache, as well as improve your chances of success of completing a round and or a sale, whatever the longer term objective is. And you know, you've worked this hard to build a great business. It's just a shame to let something like that sidetrack or derail a process. So it can be frustrating, and a lot of that goes back to your advisor selection. You know, having advisors that understand these aspects of agreements early on, I think, can behoove you. So, you know, when you're chatting with your advisors, you know, you kind of ask them their opinion on this, and if they don't know, that might give you a signal that you know, you need to get with the folks that can help you throughout your evolution as well. So that's all I'd add, Steve.
Appreciate that. Agree. And Justin and I have talked about this, but we need each other, boutique firms and big law firms. The fact of the matter is, you can do a lot of this the right way without paying big law legal fees. And big law needs to figure out a way to provide its services for a more efficient and lower rate environment. And so, tempted to tell people that if you go to Cooley and DL Piper and other great law firms' websites, there's a lot of good stuff on there that, frankly, Justin and I use. And really, as we talk about angels, we're going to get in at the first outside money now. I'm all for keeping things as simple as possible as we check off these critical boxes, meaning it's better to have a 5 to 6 page prenuptial agreement. It's not complicated and 25 pages long, than to have nothing. On the other hand, if you draft your own agreement from LegalZoom, you might often be worse off than if you had not done anything. So, you know, my son was asking me recently, he's brilliant like all recent college grads, right? He says, Steve, or Dad, you're a CPA lawyer, and you said you got some kind of master's in tax, and you pay a Richmond accounting firm to do your tax return. What's that all about? Why would you spend that money? Or why didn't you just buy the trees and plant them yourself in our side yard? And part of the message here is maybe it's because I'm older than you guys, but pay the people who know what they're doing, what they're worth to do stuff that you don't really need to be doing. Well, you should be focused on your business. But Justin and I sing this loud and clear to the local CBIC in Charlottesville to Richmond entrepreneurial communities. Demand excellence, which is Matt's point. Have the right advisors, but by all means, make sure you're getting value. You're paying fair fees, and expect him to be transparent. So angels are called angels because they're manna from heaven. Your parents won't loan you the money. You've tapped out UVA or Virginia Tech. You've tapped out. Hopefully you've been fortunate enough. Justin and I work on these pretty frequently, but maybe you've gotten $250,000 from CIT. Maybe you've done, this is something that's kind of the latest and greatest. It's receiving a lot of attention. Maybe you've done a royalty deal, essentially a percentage of revenue deal with a family office, or a deep pocket investor who says, I don't want your stock. Give me 10% of your revenue when you start this platform up and it's live for 3 years, and then I'll shake your hand and I'll be gone. So I've heard a lot more recently about revenue royalty arrangements that are kind of a non-equity approach to paying investors back on the come, giving them upside, which they can be comfortable is not going to be diluted from their perspective by your overpaying your lawyers or your CEO, because it's based on revenue, right? Investors and buyers love, buyers love EBITDA-oriented earnouts, but sellers and investors really want revenue-based streams of payments. So before you issue equity or even a safe or a convertible note, we're going to talk about these because Justin and I do a lot of work in this area. And Matt's partner, Darden Bell, hates us for it at the end of every year because each of these animals raises unique and complicated tax issues that some lawyers and accountants and certainly entrepreneurs are just not prepared for. So we want to touch on those. But think about non-equity, non-traditional bridge debt alternatives. And then when you've exhausted those alternatives, state grants, CIT, UVA might do a royalty agreement for patented technology and they get a 5% warrant on top of it. Customers and suppliers can be very good partners. A supplier might give you free stuff for 3 months if they believe in your vehicle to grid technology. Customers might prepay you. We've got technology clients whose customers will prepay to develop stuff for them. So once you've tapped out your credit cards, you've done all the bootstrapping with alternate sources that, with apologies, I didn't really plan to spend a lot of time on today. When we talk about angel financing, a couple of important things. One, compared to 5 years ago, companies are raising seed capital, pre-Series A, seed capital from friendlier investors, wealthy people, family offices, in some cases, seed funds, and former entrepreneurs over a much longer period of time than they used to, meaning like the 1990s when companies went public without a business plan in 6 months, it just takes longer to get to a Series A. So fortunately, the heroes of venture capital, angel investors, have seen the opportunity to bridge that need. And raising money is hard, right? But what I'm seeing is multiple rounds. I've got 2 or 3 pretty local clients who've had 3 or 4 rounds of seed money, preferred equity and convertible notes, all kinds of mix, who are still not at their Series A. And so that's important because in the old days of venture capital, the irrational exuberance days when investors and buyers might not have been quite as careful and smart, everybody rushed to their Series A, B, C, and then to an IPO. And a lot of people lost a lot of money. Investors are smarter, and even angel investors are more pragmatic today, but they've also gotten more patient, and they understand that this runway on which you slice the pie for the founders, you dole out equity to your sweat equity folks, your team, and then you look at it as kind of a more patient source of capital. So in this angel slide that's on your screen now, most of the people listening to this call, and certainly my 2 co-presenters, understand that convertible notes and SAFEs, which is the acronym for Safe Simple Agreement for Equity. Some days I wish it had never been invented by a really smart lawyer at Cooley out on the West Coast. It might have been Wilson Sonsini. Justin would know better. But essentially, entrepreneurs and investors don't want to get to the awk conversation about what we're worth, because nobody knows what we're worth, right? We could be worth 15 million, we could be worth 4 million. We're never going to agree on it. So we need to make payroll, and we need to finish development of our software. Let's not worry about agreeing on valuation. Let's kick the can. And what we'll do is take your money and give you a convertible note or a SAFE. I think the East Coast practice, and definitely a safer one for investors, a little more sort of a hog type feeling for founders and companies, is the convertible note. SAFEs are the greatest thing since sliced bread for founders and startups. If you can find an investor who really cares that little about legal protections, and there are a lot of them out there. One of my partners years ago defined venture capital as money that an investor can afford to lose. So it's sort of a lottery ticket, right? And so a lot of the high-profile angels that we know, from Virginia Beach to the Valley, certainly in Richmond and Charlottesville, for a lot of these people, 2 million is nothing. A lot of these people will wire the money before they even get a subscription agreement or a PPM or a brochure about the company. So they're good people. They believe they're also doing something charitable. They back the right companies with the right teams. Not everybody's that way. But with convertible notes, there's great forms out there. Justin and I have them. Be careful about them as founders, because like Matt's comments on terms that you've sold and you may have to change later, convertible notes can be painfully dilutive. So typically what that means is that a $500,000 investor gets a $500,000 convertible note, which automatically converts into equity of the company at a discount of 20% off of the price that you issue stock for in a future round. So you've got that, might be fair, but you've got that price discount. What's happened in the last 2 to 3 years is that because the masters of the universe love complexity, but then they whine about tax, accountant fees, and lawyer fees when we have to explain this stuff to pragmatic business people. The market has loaded on top of that of price discounts, which can be 20%, they can be 10%. I've seen some 30%. That feels rich. They've added what's called a valuation cap, and this one strikes me as really uncomfortable and unfair in that what it means is, look, we think your company's worth $15 million. You think it's worth $30 million, but whatever it's worth, we're not going to convert at a level, even with our 20% price discount, which determines the number of shares we convert into. If you're good enough and successful enough to do a Series A round at 40 million or 50 million, it's an odd incentive to say, we're happy to be your angel investors, but we want to saddle you. We want to, regardless of when and at what level you do a Series A, which you would think would be great news to these angel investors, because it's going to be less dilutive for all of these folks, right? The founders and the angels, in addition to our key people. But they get into the deal with sort of a fixed price. They've never really gotten over the valuation trap. So essentially, to me, and I want you guys to argue with me, a valuation cap says again that whatever you issue your stock for in a Series A, we'll congratulate you when you do it. But if you do it at 50 million, we want to convert as if you were doing around at a $30 million valuation. So to me, it just feels like two bites at an apple, and people just need to understand that it can be incredibly dilutive. And that's what I've seen in my practice. And before I kind of throw it over to you guys, a priced round, I've heard Justin use the term as well, is simply, we're not going to kick the can. We're big boys and girls. Let's agree on a value. So we do an angel round at some price per share, $9, $12. It's the value of the company divided by the shares that the founders and the key people own. That should determine what the investor should pay, right, per share. Problem is that valuation in the numerator, we just don't agree on. But if you can agree on a priced round and it's affordable, it's much safer for the entrepreneurs, isn't it? Because you don't have to worry about that dilution down the road, that double dilution that's exacted by the old concept, discounted price, and the newer concept on top of that evaluation cap. By the way, safe's a good deal for the company as compared with a convertible note, because it's economically exactly the same, but you never have to pay it back. It's not debt. So for an investor, it feels a little unsafe to me if I represent the angel to a company. I'm all for it, you know. Get all the safes you can get. And we have been successful negotiating some of those for Charlottesville businesses who are talking with Miami and Silicon Valley investors. You do save legal fees. There's a lot of negotiation around the valuation caps and discounts, but clearly the company is in a better position because it's not true debt that has to be paid back if you don't do a round by some late date. The other thing I want to jump in on, I'm going to get out of the way. Preferred equity sounds investor favorable because they get their money back first. Who cares? If the company is worth 15 million and somebody gives you 2 million, if you can't afford and you dump the company for 4 million because things don't go well, the value actually goes down. Most of my clients say, I don't care whether we have to give them their money back first. We're betting on 40 million. we're going to hit a triple or a home run. The cool thing about preferred equity, and Keiter knows all about this for option and tax planning purposes, is that if you issue preferred equity that has a liquidation preference, meaning these angel investors get their money back first before the founders get their share, you can actually reduce the percentage ownership that the angels have in the company. What does that mean? If a wealthy person in Charlottesville comes into a business for common stock, she might insist on 30% of the company, but if she comes in for preferred stock, she might be comfortable with 15% upside in the company after she gets her investment back upon a sale of the company. There's two types of preferred. One is you get the higher of what you put in the company or what your 15% is worth, right? Which hopefully is going to be higher. Or participating preferred double dip, where you get your money back and then we give you 15% of what's left over. That can be kind of expensive. 8% preferred hurdle rates on preferred stock can be expensive. So the messages here are convertible notes and safes are great, but be careful about discounts and caps and how they're drafted. And if you're issuing equity, try to issue common. A lot of really cool, wealthy angel investors are willing to take common because they can afford to lose the $2 million. If they're not that cool and you've got 4 or 5 people that negotiate preferred equity, careful about giving them Series A strength preferred equity. Give them non-participating. They shouldn't get an 8% annual cash-on-cash dividend. It doesn't make sense. And give them an investor rights agreement, my last bullet. I've got one right now, and so does Justin, fresh off my printer, that's really a one-size-fits-all, which gives them fair stuff, but nothing that a entrepreneur should be afraid to give up. And what are those things? The first right, preemptive right to invest in the next round. When I tell clients an investor wants the first right to put more money in later, the investor goes, heck yeah, I love that. They're going to come back. It's a nice problem to have. There are some veto powers that some angels will ask for, like, I need to approve a sale of the company. Sure, Matt's run into that. Investors have voting rights or board rights. They may want a board seat. So out of the 10 to 15 to 20 Series A investor rights on a list that Justin and I can send you all, an angel, the right angel investor, the cool angel, the kind of angel investor you really want is somebody who's too busy to bug you every month. They've got so much money they can afford to lose $500,000 to $2 million. If we can't find that person, you may have to negotiate with an angel group or a larger group of people who might be pickier in what they're asking for. Meaning, no disrespect to angel funds and smaller investors, but in angel rounds, I really look to sort of drive the process and say, we don't want to give you Series A terms now. This is just an angel round. But my entrepreneurial client is smart enough to know, he or she knows that preferred equity is fine. And, but we just don't want you to get greedy and too rich on terms because we don't want to establish a precedent for the Series A. We want it to be as friendly as possible, and so do you, because when the Series A comes in, that's usually a venture capital fund, then they're going to look at our cap table and they're going to say, well, if Daddy Buck's investor or Mrs. CEO of another tech company who gave us $1 million, and we're really thankful for that, got these rights, we want those rights plus, twice as many. So we want to do angel rounds, which I call sort of preferred light, as frequently as we can. but don't get carried away and use the NCVA Series A preferred stock forms, because those should be, frankly, deferred to your Series A round. And by the way, guys, Justin will talk about this in the future. Those forms are drafted for investors. They're not drafted for founders, for companies. So be careful about who NCVA, great organization, represents. They're really a trade association for venture capital funds, as they should be. So be careful about those forms. So shorter documents, friendlier documents, focus on economics. Hopefully it can be more legal light. And hopefully that makes our Justin or my fees more swallowable as well. So what about, by the way, seed is just an unfancy word for pre-Series A. I think we could argue about that. And mezz is sort of hybrid. Is it debt or equity? Is it both? This investor might want a note. A lot of rich people have strong ideas about what they want. I know some in Charlottesville who prefer a note with 8%. They want to get some cash every quarter. Most startups can't afford that. But existing companies who've never done a round might be able to afford it. Some investors want a note plus a warrant, which is like an option to acquire equity. So when the masters of the universe and people who act like they know more than you entrepreneurs, but they really don't because there is no market, talk about mezzanine capital, it's pretty much everything between convertible notes and equity. It's notes plus warrants. It's everything between bank debt and equity. It's tailored, creative, hybrid securities that, like preferred stock, like convertible notes, or like combinations, for example, promissory notes, pure debt plus warrants, that kind of mix and match upside with equity risk and downside protection. You got to pay us back or pay us first with interest, more debt-like risk. So the good news is, and the truth, if truth be told, is there are market terms out there that advisors can talk about, but every deal is different. Every company is different. And if you find the right investor, the entrepreneur, founder, and that investor are going to draft their own terms. They're not necessarily going to copy somebody else's term sheet. It's kind of a dynamic back and forth.
Awesome. Steve, thank you so much for that. Matt, thank you. We're about out of time, but I'd like to give Matt the opportunity if you had anything to add just then.
All great points by Steve. The couple of takeaways that I would say, just in addition to what Steve mentioned, are to the extent you can, having enough capital to at least get you 18 months down the road. You hear some people raising amounts shorter than that. If you think about it, raising capital is a time-consuming process if you're an entrepreneur while trying to build a business, build a team. So give yourself some time if you can, and always raise a little bit more, so that gives you time to execute, because it takes time to raise capital. It is not easy, particularly in this environment, and particularly if you've seen some of the latest data from the Money Tree survey or NVCA. It is just it's taking longer, and there are fewer deals getting done, particularly at the seed round level. The other things that I would mention, I just wrote down, is we talked a lot about picking partners. Make sure you really know your partner. Make sure there's alignment. Just because someone's willing to give you money, that doesn't necessarily make them a great partner. So, ask the right questions, understand what their motivations are, get to know them to the extent you can, because that can make a world of difference in your success, between someone calling up and saying, as Steve said, where's my cash distribution? As a young company, that's a misalignment. So don't get in that situation. And, you know, the other thing is, just like Steve said, I know from Keiter's perspective, you know, we see a mix between convertible notes and then some form of equity, whether it's common or preferred, as a more frequent investment structure. That's what we frequently see amongst our clients. But to the extent, as Steve mentioned, you know, common or kind of a straight preferred, convertible preferred can be great sources and structures of financing, just depending on the specifics. So again, it comes back to talking to, whether it's Steve or Justin or your accountant, have a dialogue. You know, don't be afraid to share the conversation, to get someone else who's been through this to help you think through it. That's all I'd add.
Cool. Matt, thanks so much. I'm going to add one thing and then I'm going to wrap it up. Just one thing I wanted to touch on about the safes. While they are, I agree with Steve that they're more founder friendly than a convertible note because they don't have the traditional features of debt. Safes, my understanding is that safes do not qualify for the qualified equity and subordinated debt Virginia tax credit, which is a great incentive to get investors to invest in your startup if you're a Virginia company or the investor has some sort of Virginia income that they'd like to offset with credit. With that being said, thank you, Matt and Steve. Thank you again. This was very informative, very insightful. Thank you so much. That concludes the end of part 2 of session 3 of the For the Founders series. Thank you very much for listening in. I would also like to thank our sponsors, Wells Fargo, McGuireWoods, Keiter, Catalyst, CSH Development, Fahrenheit Advisors, and Leidos. Please join us for a live webinar component that will encapsulate all of session 3 at 2 p.m. on Tuesday, June 9th. Again, it's going to be a Zoom webinar. We're going to have representatives from Keiter and McGuireWoods discussing more of your questions and the details as to maybe more uniquely tailored to your specific problem. So please join us then. Look forward to seeing you. Thank you very much.